FASB requires a classification on the balance sheet. So what are these classifications? While items must be grouped in areas of common characteristics, the classification is important because it provides additional information for the users of your financial statements. The balance sheet classifications helps in looking at liquidity and long-term solvency. And it's required because the usefulness of this statement is increased when you classify items. There's a broad distinction between current and long-term, and this broad distinction is very useful. So liquidity, what is it? It's the period of time before an asset can be converted to cash or a liability is paid. The information is important in assessing a company's ability to pay its current obligations. Solvency in the short term. Financial flexibility, the ability to alter cash flows in order to take advantage of unexpected investment opportunities and needs. That's what financial flexibility is. Now, thinking of long-term solvency, the riskiness of a company regarding amounts of liabilities is based on its capital structure. The risk to investors and creditors increases as the percentage of liabilities as opposed to equity increases over the long term. So assets, these are probable future economic benefits obtained or controlled by a particular entity as a result of a past transaction or event. That's actually the FASB definition. The key to remember, future benefits from a past transaction. Liabilities, the FASB definition, probable future sacrifice of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of the past transaction. So, way to remember this. Future sacrifice, you have a present obligation because of a past transaction. These are your creditors' claims on your assets. Now, equity, the other side. Remember, assets minus liabilities equals equity. So your equity, another term for this, is called net assets. This is actually the not-for-profit term. Instead of calling things equity in not-for-profit and government accounting, they call it net assets. For a corporation, it's either shareholders' equity or stockholders' equity. It's the residual interest in the assets of an entity that remain after deducting all liabilities. Because remember, your creditors have claims on your assets first. The remaining equity are the owner's claims on the assets. The classification, current assets, investments, property, plant, and equipment, intangible assets, and other assets. Liabilities must also be classified current and long-term. And remember from accounting principles, this must include your current portion of any long-term debt. How much of that note do I have to pay this year? The equity, there'll be two main components: contributed capital, or your owner's contributions, and internally generated capital. Now, assets, the current assets, briefly going over a list, and this is really the order that it should be shown, order of liquidity. Investments, these are looking at investments in other corporations. Land held for speculation that you're not currently used in operations has to be classified in your investments. Non-current receivables also goes down here, where your current receivables are up in the main current assets. If you have cash set aside for special purposes, you have to classify that with your investments. Then property, plant, and equipment, sometimes abbreviated PP&E. Land, buildings, those long-term assets. Intangible assets, different types: copyrights, patents, franchises, leaseholds, leasehold improvements, trademarks. These are amortized. Goodwill is the one exception. It is never amortized. Instead, you're required to perform an annual impairment test, and that is studied in a later chapter in intermediate accounting. What are other assets? Well, they're long-term prepaid expenses, maybe deferred charges. They're not current this year, or not going to be currently used up this year. So But the best way to remember this, anything that could be included in other categories, but it's not a material amount, you put it down below on the very bottom, other assets. So now liabilities. You should be familiar with these. Long-term liabilities. Pensions are looked at in the second semester, as are leases for the second semester of intermediate accounting. Other long-term deferred revenue, it goes into long-term liabilities. Income can be current or long-term. If you have a payment plan set up with the IRS for back taxes, if it's not due for a number of years, you have to classify just the current portion and the long-term portion. Then there's equity, contributed capital, and internally generated capital, retained earnings, accumulated other comprehensive income, if there is any. If a company does not deal with AOCI, then you simply leave it off. Treasury stock is always the last line. It's a reduction in equity. Key to remember with contributed capital, paid-in capital is a category, just like revenue is a category. Paid-in capital excess of par is an account within the category, just like sales revenue is an account within the category of revenue. So balance sheet classifications, assets and liabilities are not listed randomly. The more you understand how to classify them, the more you'll understand what you're looking at when you're analyzing a financial statement. There is a broad distinction between current and non-current, and that is a review of